Hi, good evening, everyone, and a warm welcome to our LLF Let's Learn Futures webinar series. We are thrilled to have each of you here today with us. And before we begin, please confirm in the chat box by typing yes or sharing an emoticon if you can hear me clearly. If you're able to hear me clearly, please type in yes or one-on-one in the chat box so that I know everything is working well on my side and your side as well. Great, thank you very much. Now, today's Let's Learn Futures webinar topic is Backtest, Refine, Profit, Advanced Strategies for FKLI and FCPO Day Traders. This LRF webinar series is proudly brought to you by Bursa Malaysia in collaboration with Excellent. I'm CY Saw, your moderator for today's session. We are privileged to have Dr. Ahmad Daniel joining us to share about what are the advanced strategies for FCPO and FKLI traders, what works and how you can incorporate these strategies to your trading to gain an edge. So let's get started. I see there are more people joining this webinar room. Welcome. One more final quick check before we begin. Just a final sound check. Please type in 111 or give us a thumbs up in the chat box if you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. Great. To ensure you have the smoothest and highest quality video experience, I recommend that you turn off your video camera during this session, as this will help minimize internet bandwidth usage, prevent interruptions, and ensure an optimal learning experience for everyone. Today's session will be divided into two parts. The first part, Dr. Daniel will present his sharing. Following that, we will be having a Q&A session where you can ask questions related to today's webinar topic. There are some new improvements in this webinar platform interface, as you can see here. And to ensure we can address your questions effectively, please follow these few steps. The first thing is that you need to find there are three buttons on your right hand side. Click onto it. Then you will be able to find a Slido Q&A. So all you need to do is click on that. Then there will be a message box popping up. And this is where you can type in your questions. And please note that due to the high volume of messages in the chat box, it may be challenging for me to spot your questions if you don't use Slido for Q&A. So feel free to type a question in the Slido box at any time during the session. As this is the LRF Let's Learn Futures webinar series brought to you by Bursa Malaysia, we have a lineup of exciting topics ahead to help you deepen your understanding of futures trading. Every Tuesday, we will host a new webinar topic in this series featuring sessions in Malay, Mandarin, and English. Our panel of speakers and experts will share their valuable knowledge and insights and also practical strategies related to futures trading. We have many content-packed and informative topics lining up, with more being added regularly. So if you're interested in enhancing your knowledge and skills in futures trading, so what you need to do is just that you simply scan the QR code to register, and don't forget to add this session to your calendar so you won't miss any of them. Besides that, we also have the Let's Learn Futures online workshop. Now, this online workshop is specially designed for those of you who are new to futures trading. And in this workshop, we cover a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract. Each session is 3 hours long. The upcoming LLF online workshop session will be this Saturday, conducted in Mandarin language. And the next upcoming online workshop will be next month, conducted in English. So if you're new to futures trading and would like to learn more, you can register these online workshops. They are entirely free and fully sponsored by Bursa Malaysia. And please note that the attendance is limited to the first 50 online participants only. So be sure to grab your seats quickly. Before we begin, it's my pleasure to introduce our speaker for today, Dr. Ahmad Daniel Zainuddin. You can call him Dr. Daniel. Now, Dr. Daniel is an academician and finance professional with strong track record of contribution in the financial market research. And currently, he serves as a senior lecturer in Asia Pacific University of Technology and Innovation. Prior to academia, Dr. Daniel has extensive industry experience in the capital market industry in various banks, and he specialized in structured warrants and derivatives trading. And besides that, Dr. Daniel is also a certified financial technician. So without further ado, let me pass this presentation over to Dr. Daniel. Dr. Daniel, the floor is yours.
All right. Thank you, Mr. CY. Let me share my screen right now. Okay. Good evening, everyone. My name is Dr. Daniel. So thank you so much for joining us tonight for webinar session, Backtest, Refine, and Profit. This webinar session tonight, this slide specifically, I designed it to share with you the advanced strategies for FKLI and FCPO day traders. Those are actually combination of input from my observation as a dealer last time and also as an academician. So I would say that tonight's input gonna be very insightful for you, especially if you are beginner traders and intermediate traders. For advanced traders, probably you find this information from this slide will be quite common. However, some others probably very beneficial for you in gaining new knowledge for any parts of FKLI and FCPO day trading. All right, let's just get started. Okay, why actually, before I start, why actually we want to focus for day trading? Okay, the thing is, I think everyone knows that derivative market, or if you want to trade derivative instrument, doesn't matter how long you hold your positions, whether you're holding it for 1 day, 1 week, 1 month, or 1 year. Yeah, some of the traders, they like to trade farm. I don't know why. Although I've been into trading days for close to 10 years, last time, I'm not sure why they like to trade farm, as in like this month is April. They like to trade some very far contract month, as in like December 2025. I'm not sure why. I did ask them. The thing is, the response is not very convincing. Probably they just for simply for fun. However, back to what I want to say just now, it doesn't matter how long you hold your positions, the futures market won't give you any dividend, right? As in, it won't be like stocks. If you hold for some time, probably it can give you some dividend. It doesn't matter interim dividend or annual dividend, but for futures market, it won't give you any. The thing is, it will only give you capital gain. So that is what we are aiming. We want to try to earn. We want to try to profit in any way possible. So that is the purpose of the organizer, Mr. So. Okay, Mr. Siwa, try to share with you tonight. All right, so I have 4 things I want to share with you today. Okay, let us have a quick glance about getting started with day trading in FKLI and FCPO. Of course, we refresh some introduction to day trading. For FKLI and FCPO, we try to explore the key factors that drive these markets. Some of them probably we are discussing about the fundamental factors. Try to weigh the benefits and challenges of trading these features, because we have other fields. We have FGLD, we have other global futures contract as well. That is number one. The number two, the second thing that I want to share with you tonight is the effective day trading strategies for FCPO. And this input is basically, I obtained it empirically. Empirically means it's not merely or simply based on observation, but testing it with the real data. And that's what I want to share with you tonight. Number three, I'll try to share with you the way of you to manage risk and measure your success for your day trading. Because based on my observation, when you are trying to trade, I believe regardless you're trading stocks or trading the crypto or derivative, what matters most is actually you manage the risk. You manage the risk, I believe you can secure your profit. Secure your profit means we are not talking about how much the profit is, but the thing is the opportunities for the profit, for you to earn the profit is always there. With the condition of you need to manage your risk. And number 4, actually last time I think that I only want to share 3, but then I believe the number 4 point similarly or equally important to be shared, because based on my experience, some of the traders, this one is regardless whether it's a beginner trader or it's an advanced trader, they like to combine the FCPO and FKLI futures contract in one trading account or in one holding position. That is something that I was struggle to understand as well, because FKLI and FCPO, both of them carry different degree and magnitude of risk. So, but never mind, in case some of you interested, I'll be sharing that as well tonight. Okay, all right. These are 4 things that I think the most important parts of the trading. So let's go to FKLI. But before that, let's have a refresh about futures contract. Futures and contract, the textbook definition is very simple. Okay, futures contract is a form of or type of derivative instrument, whereby it's a contract between a buyer or seller. Okay, it's a contract between a buyer and seller. It's a contract, is an agreement between a buyer and seller to buy or sell something in future. But everything, what I mean everything is the details are set today. The details will be the quantity, the quality, when to deliver it, where to deliver it, everything. Okay, everything is set today. But when it to be delivered is set today, but everything else, the delivery will be happening in future. So that is the textbook definition of futures contract. The thing is, some of the non-finance, they were wondering why we call it as a financial derivative. Because especially last time I got a clients from engineering background, we know engineers, they are, they are very familiar with the word derivative because they learn calculus. So they asked me, is this anything to do with the calculus, the integration, the dy, dx, and those things? I said no. So what's with the derivative? What's with the word derivative? All right. So as we know, futures contract is a form of derivative. We name it derivative because it's a contract that given a value. When the exchange establish a futures contract or any derivative instrument, they need to give a value to the derivative, to the instrument, to the contract. So where did they get the value? So they get the value from the spot market. Okay, they get the value from the spot asset. So simply to say, the value of futures contract is derived from the spot asset or the underlying asset. As in, like tonight we're talking about FKLI and also FCPO. Technically, KLCI futures, the value of KLCI futures or KLCI futures contract is derived from IBM KLCI, and same goes to CPO, FCPO. Okay, the value is derived from its underlying market as well, which is the Malaysian crude palm oil, physical Malaysian crude palm oil. Why I need to highlight about the word Malaysian? Because in this world we have quite a few origination of crude palm oil. We have one in Dalian, we have one in other parts of the world, especially Indonesia. So we have to mention Malaysian physical crude palm oil. So those are actually the textbook definition about the futures contract for your revision, short revision tonight. Okay, hopefully you're still following me. First, FKLI. Let's take a glance about the features of BMD FKLI. The underlying asset is ABM KLCI, the contract size, index value times 50 ringgit. The tick size, every one index point movement equals to 50 ringgit. The settlement will be cash settled. Of course, they are not going to deliver you the physical contract. Even me myself, I don't even see the physical contract of the KLCI futures. It's just a virtual contract. So it will be cash settled. Cash settle means let's just say you are trading May contract, KLCI futures May contract at the end of business day or trading day in May. If let's just say you are in the money, hopefully you know what is the meaning of in the money, out the money, at the money. If you are in the money, so the broker will give you your earnings. If you are out the money, of course, you will see some of the amount will be deducted from your trading account. How about if you are at the money, you bought and you sold, your position is closed at the same price? You also will see some amount will be deducted from your trading account. Why? Because it involved, your trading involved incidental costs. Incidental costs means your transaction costs, your commission, your levies, and everything. So that's why the practical definition of at the money for futures trading is not exactly, you're not losing, you're not gaining. That is a textbook definition, it's a finance textbook definition, but we need to consider the commission as well. Okay, all right. Right now we have 3 sessions: morning, afternoon, after hour. Leverage, allow traders to gain exposure to FBM KLSI with smaller capital outlay. I believe that only this morning, or I think yesterday or this morning I got updates about new margin for both KLCI and FCPO. And the KLCI features, I think, 5,500, if I'm not mistaken. However, that is relatively small if you compare with trading the whole index. There are 30 stocks in the components of FBM KLCI, and it will be very costly if you want to trade it all. So that's why to get an exposure of the KLCI, the stock index, it's better for us to get use of the market dynamics by trading the KLCI futures. Okay, so that is the futures. How about the users? The users, hedging, I'm not sure retail traders apply this. Speculation every day. Arbitrage, I barely see one. I would say honestly to speak, I barely see. I would say that I don't say seldom, I don't say rare. It's just that I'm not sure whether some retail traders doing arbitrage. Probably they are doing it, but it's just that they don't tell me. Okay, probably they just quiet about it. However, from their end, oh, I'm doing arbitrage. The thing is, every day I would see speculation. Why speculation? Because you are trying to forecast, you're trying to determine where will be the next direction of the futures market, particularly KLCI futures and also CPO futures. So these are a quick refresh of BMD FKLI. So let's go further. Hourly FKLI, what we've seen in 4 years. So these are actually computation of hourly price for KLCI futures first month. I need to highlight first month. Why first month? Because the liquidity, the active month, the volume. The price on your left hand side, the price is the price I show there, the mean, the median, minimum, and max in 4 years. On your right hand side, return. Mean and median quite the same, 0%. Actually, if you put there like 6 decimal places, you will see some numbers. It's just that I want to make it simple. I just put 2 decimal places there. The minimum negative 2.41 and maximum 1.85. Okay, the thing is on your right hand side, some of you probably have a statistical background. If you ask me, if let's just say I am assigned to study about market dynamics, I really like to start my analysis with descriptive statistics. This is the descriptive statistics, whereby it tells us about the mean, median, minimum, maximum, standard deviations, skewness, and curtices. Why? Because thus the name descriptive statistics basically telling us the description, the behavior of the data. I would say the illustration. It's indicative of what would be, what is the market looks like. So from here, we can see that mean and median is just 0. It means that for hourly data, let's just say 3 o'clock, the KLCI futures we see at the level of 1,500. It goes up, it goes down. At 4 o'clock, it will end at 1,500 as well. The thing is, in between, it moves somewhere, go up, go down, go up, go down, but then it ends at the same level. So that's why the mean and median shows the same number. Minimum negative 2.41 is actually higher than maximum 1.85. It shows us something. indicatively, we would be, we will be expecting a short position will gain more than if we have long position in KLCI futures. Why? Psychologically, fear. Investors fear. This one is being described and discussed and explained well by finance scholars in behavioral finance discipline. Everyone has fear, and fear, what else other than fear? We have greed, but the thing is, greed is not as larger as fear. When we fear about something, as in like what we faced recently about the tariff, everyone selling it, everyone shorting, everyone sell off, everyone to cut off everything. So that's why there's a logic. We see here the minimum return, hourly return is even larger than the maximum return, hourly return. Next is standard deviation, whereby we can see the bands of movement going up, going down, going up, going down of the mean. The skewness and kurtosis I will share later. All right, so that's what we can see at a glance. What is the descriptive statistics of the price and return for the KLCI futures? Okay, now how to make sense out of those numbers? The number is just a number if we don't know how to interpret it. So it maintains and retains as a number. It doesn't give us any indication. So now we try to interpret it. So when we say mean return, it means that no clear direction. Short-term trades, we can say better than trend following. Okay, so if let's just say you are, I am a financial technician myself, but however, looking at the LCI futures descriptive statistic, I think better to do short-term trades rather than trend following. Okay, rather than looking for pattern or it's going to go up, it's going to go down. Let's try to do head and shoulders here. Let's try to do, any support or resistance here. Actually, short-term trades for long or short in Gaussian averages will give you more opportunities to profit. Low volatility, I think this one everyone would agree. You will spend hours and hours. If let's just say there is no fundamental, no big news, you will spend hours and hours to see if your limit orders being hit or not, matched or not, order fill or not. I think most of you here will agree. It's very, very, very hard to see, any movement of Gaussian futures given that now no fundamental coming in. What else? FKLI, which is shown by the curtacies. It shows that the spikes, the sharp spikes and drops are quite seldom, quite rare. But once it happens, I would say that it's better for you to put your stop loss ready. And from my observation, stop loss, when you place it, better not to revise it. That is my, mere observation, my gross observation, because this is psychology. When you put your stop loss at the first time, basically you're already studying it. Okay, this is the price that I short, or this is the price that I long. This is practically how much I am willing to lose. So let me just put a stop loss at this level. However, when the market move, either in your favor or not in your favor, you tend to have that strategy of not strategy technical analysis, not strategy of fundamental analysis. You will use a strategy of hope. If it's not going your way, you're hoping that the market would reverse or rebound to go on your way. If the market goes further in your favor, you'll be hoping that it will go higher and higher, or lower if you're shorting, right? Because you want to accumulate your profit. That is very dangerous, and that will lead you to revise your stop loss. However, the data here shows that, okay, curtosis 9.5. Anytime when the sharp spikes or sharp drop happen, when you always revise your stop loss, that will not going to end in a good way, right? So negative skew, negative 0.31. We will say here, more downside risk than upside. Be cautious of sudden drop. Realistically, the traders, or we would say the investors or the participants in the market, why they are trading LCI futures. Okay. Before that, I would like to refresh your mind. There are two types of participants in the futures market. One is the speculators. The other one is the hedgers. Of course, like we mentioned just now, like we covered just now, people are more afraid of downside risk or the bearish market. So because of that, it is being captured in the price movement or the return movement in here that explains the negative skew. More downside risk than the upside. It is quite seldom or is quite rare people want to trade to ride the bullish sentiment in the market. It's more to this situation. I cannot, my equity position, my equity investment not really work out. So let me try KLCI futures. So that is why we'll see more downside risk than upside. If you're shorting, more opportunities for you. It wasn't me, the data said it. And lastly, minimum negative 2.41 versus maximum 1.85. We will say that you will, if things are not going your way, you will have the chances that your positions to go wrong more than your positions to give you some earnings, because let's just say you are long in a bearish market with a strategy of hope, that will, your loss will hit harder than when you see that you are gaining. The gain is very small, but then the loss will be much more than the gains. All right, so that is how we interpret the descriptive statistics from here to here. So what is actually you need to do? What we can do about it? So what? Okay, we have covered the numbers here. We have covered the interpretation. We try to make sense out of it. And so what? So we would say that we probably can try scalping or range trading, whereby you can consider BB, Bollinger Band. Personally, I would prefer, or I would say that I like BB so much because I'm a very simple person. Okay, when I use BB, I don't need to think much about where's my support, where's my resistance, because support and resistance, especially in the pivot points, okay, they are changing every time. So it's quite hassle for me to calculate every time, to determine every time, every time I want to know what is the updated support and resistance level. Not only that, as you know, we have support 1, support 2, support 3, resistance 1, 2, 3. So it's very hassle for me. Instead of using those indicators, it's better for me to just use Bollinger Bands. Okay, BB. But why? Because BB will give me the upper band, the lower band, and also the middle line. The middle line actually reflects the MAs of the market itself, the price itself. And probably you need to consider about the RSI to see the overbought and oversold condition. MACD, stochastic oscillator. Other than that, okay, other than BB, I also personally, however, when I say personally, it's not necessarily that you need to follow. Okay, it depends on the market, it depends on the timing. Some of the time probably RSI can be used better than stochastic or BB. Some of the time you may consider ATR, average to range. Some of the time you can consider MACD, but so far MACD, although it's the oldest, okay, I would say still relevant for detecting momentum shift and entry signal. Other than that, stochastic oscillator for you to see quickly any overbought and oversold crossover. The same thing with the RSI just now. ATR to measure volatility, adjust stop loss level if needed, if required. We don't actually revise our stop loss levels every time you see the market move. All right. Okay. Other than that, still your stop loss. I really would like to highlight many times about stop loss, because most of my experience seeing that the traders revising the stop loss always end up not in a good way. So that pretty much about it. And number 3, use leverage carefully. I would say that some of you probably having a very good facility or specialty from your broker, which is intraday half margin. So if let's just say the market goes on your way, that intraday half margin really give you a very, very nice, good night's sleep. Okay, other than that, okay, let's just say you're utilizing your intraday half margin, market not go on your way. You will having a nightmare at that, at that, after the trading session ends. So not to say I'm not really encouraging the intraday half margin, but use it wisely, right? Use it wisely. Okay, we're done on discussion about the mean. Okay, the mean of return and everything, the descriptive statistics. Now I would like to bring you to the discussion of leverage effect. Leverage effect here is not referring to the corporate finance. We are not talking about the debt. We're not talking about the equity, the proportion of it, the structure, the capital structure. No. In the definition or in the realm of market dynamics, okay, leverage effect means a situation whereby when market drops, okay, when market drops, the volatility tends to jump more than when market rise. Again, in short, bad news hits harder because fear. Okay, fear. In order for us to determine this, okay, we need to use the econometric model. We call them as threshold gush. Gush is basically an acronym of generalized autoregressive conditional heteroclastic. In short, or in some regions, we just want to model. We just want to model the variance of the return series for the market. Okay, for the market. So there are many types of gush model. We have general gush model. We have exponential gush. We have threshold gush. For today, or optimally model the leverage effect for LCF features, you are using threshold gush. You can Google this later. So what's with the threshold gush? It helps us to check if negative shocks make the market more volatile than positive shocks. All right. So far here, it just gives us some indication, some indicative. However, we need something more robust. We need some metric that will give us more reliable numbers, more convincing decision. Okay, that's saying negative shocks in the LCF futures make the market more volatile than positive shocks. Right. So what we are looking, basically, we are looking for mean. Okay, we are looking for the omega. These are the Greeks. Okay, the Greeks, what they call the Greeks letters. We are looking for alpha. We are looking for beta. Mean, it shows us the average return. If we are running gush model, the econometrician, the statistician, they don't really care about the mean. What we are going to see more is omega, alpha, and beta. That is something that we really want to delve further tonight. All right. So next. So after we run the test, okay, we have this coefficient. Okay, alpha we have 0.0311, beta we have 0.9689. The asterisk you see here is a statistical significant level. However, that is not something that we want to discuss tonight. We are trying to make sense. We're trying to interpret what those numbers meant. So we have alpha 0.0311 with a significant level of 2 asterisks, 2 stars. It says that the new shocks only cause a small immediate increase in volatility. Short-term movement affect volatility quickly but not significantly. If you say in the statistical book, they say if you got 3 stars, it means that very, very good. If you got 2 stars, probably a less good. 1 star, still good, but then not really. No star, no good. That is a plain language way how to describe statistical significance. So that is what alpha is telling us. The new shocks only cause a small immediate increase in volatility. So if I just say the news coming in, of course, people react. The mechanics of information arrival, of course, the people react because they don't know. Am I relevant? Is my position relevant to this news or not? In other way, they react first, think later. That's a problem of, I think that's a human problem. Okay, they act first, think later. Only after that, they see, oh, this one is not really relevant to my position. So that's why the data says it only causes a small immediate increase in volatility. However, it's just a short term. Okay, it's just a short term. So that is alpha. Beta, this shows how long volatility stay high once it rises. For LCF futures, we can say that, let's just say there is volatility, okay, That explains why without any news or without any fundamentals kick in, we still see the market fluctuates unusually higher, unusually more agile than the usual days. So that's what the beta is telling us. So based on the interpretation here, we would say that advisable for you to do long regime trading. It means that I put a footnote here. Regime in finance refers to market condition or environment like high volatility, low volatility, bullish trend, bearish trend. So you can refer at my footnotes here. So first, if you are in high volatility regime, you expect volatility to stay high for a while. You might use volatility breakout strategies and probably widen stop loss level. This is the requirement if you want to revise your stop loss. So you must have a basis, you must have a condition. It's not like, hey, I want to revise my stop loss due to the market movement. It's not as simple as that. You must have a condition, you must have a basis, you must have a convincing point. Okay, this is actually a very good reason why I need to adjust my stop loss level from here to here. Okay. On the other way around, if you have low volatility regime, probably you are expecting market to continue stable. Okay, it fluctuates, but then not so much. And you can use your range trading or low risk strategies. It's just that I would say don't add up, do not increase your position. Let's just say you're starting your position with 2 contracts. Okay, just maintain 2 contracts. It's not like, okay, it's a low volatility regime, so I want to add more and more and more. That is not something very smart to do, right? Okay, it's quite technical here, I will understand, but in any way, I'll try to make it plain. Okay, next. So next one would be, we try to dissect the price discovery between KLCN and FKLI. I believe that after long time, I already left the trading desk. I realized that people are still arguing which one go first. Who is the leader? Who is the laggard? Who is the follower? Who is the leader? Yeah. So in here, we try to testing it empirically. Who move who to, who caused who to move, right? So in this slide, okay, I'm showing there are 3 methods, there are 3 approaches whereby we can confirm actually who causing who to move, either KLCI causing FKLI to move or the other way around. But the general assumption, our default hypothesis, our default assumption, okay, KLCI futures is a price discovery tool. The price discovery tool means if you want to know what would be the FBM KLCI 2 months from now, 1 month from now, we will refer to KLCI, probably April contract, May contract. So that's basically what our price discovery tool meant. So with that being said, we will say that of course FKLI was the one driving the KLCI. However, that remain assumption so long that we don't do any empirical analysis about it. So we have 3 methods, very common methods among the academic finance community. The first one is Hasbro information share, whereby it tells us which market, KLCI or FKL, is the reflecting news or data. The higher the information share, the more market-derived price discovery. Number 2, Granger causality test. Number 3, a little bit more technical, okay, vector auto regression model, whereby we are looking at the short-term relationship between FKLI and KLCI returns and how they influence each other over time. All right, so I put periods here for different futures. We got E-mini Dow, we got Nikkei 225, all of these futures. Okay, E-mini Dow, Nikkei 225, Hang Seng Index, and UK FTSE 100. Surprising thing about Hang Seng Index futures, it is actually well known since I think 10 or 15 years ago as a filter for Malaysia to screen out anything bad or anything good from the West. So I'm not sure whether this rule still or remain valid or relevant or not. Let's see the numbers here. Short term, we would say that based on the maximum and the minimum number here, the smallest and the largest number, Nikkei actually contributes more influence to KLCI futures. Okay, almost 11% of price discovery in KLCI futures. The least one is UK FTSE, the European. Okay, the European will only contribute 1%, okay, of what happened in KLCI futures in short term. For long term, we would say still Nikkei on average, okay, on average 45% compared to Hang Seng 3%. We are still listening to the European markets, okay, in order to decide what we're going to do with KLCI futures. But the thing is, Nikkei 225 still contributes most of whatever happened in KLCI futures. However, these two, short term and long term, we assume stable market condition. How if we take over or we consider three instability period, COVID-19, JFC, and also Eurodebt. So very hard for us to interpret one by one. Let's just put a conclusion here. So overall, US market drive the mood. Overall, watch the Dow, what you can do. Okay, watch the Dow, watch the Dow, watch the Dow. So during COVID-19 and also Eurodebt, the E-mini Dow contribute the most compared to this fall. Okay, compared to this fall, whereby during COVID-19, E-mini Dow contributed almost half or whatever happened to KLCI futures. If the market goes up, if KLCI futures goes up, 50% of it we need to blame Dow. Okay, 50% of it we need to blame Dow. Oh, it's because of Dow move this way, Dow moves this way. The same situation happened during Eurodebt. Also, almost half of the movement in KLCI futures is due to the movement in E-mini Dow. It's not the Dow Jones spot market, but it's actually the futures, right? Watch the Dow, S&P 500. This one is we are talking about the spot market as well. Watch the Dow, S&P 500, and US policy news, as in like what we are having recently, tariff as well, because they often set the tone for global markets. Is one I think everyone knows. KLCI futures can react to US move even before local news kicks in. That is number one. Number two, Hang Seng Index, HSI, here. Okay, HSI here. Basically, it's an Asia's barometer. It's very useful as an early signal. So, if it is up to me, I would say that it's better for us to refer to Nikkei and also HSI. However, the data says, our early data says better to refer HSI as an indicative early signal for Asian market sentiment. Number three, Japan no longer sets the pace. Okay, the pace here usually, last time, yes, Nikkei will give us indication. However, hourly data says not so much, right? Okay, so that's about it. COVID-19, JFC, Eurodebt. Next. So this is KLCI futures and the rest of the world. But how if we compare KLCI and FKLI? So FKLI reflects new information faster than spot market. So we need to watch FKLI for early signal before trading stock. Okay, all right. So based on the table here, KLCI and KLCI futures first month, they have correlation of positive 0.84, is quite high. However, we need to see the Hasbro information share in here, the values in here. For IBM KLCI, actually it only contributes 0.2318 for KLCI futures movement. However, for KLCI, okay, KLCI contributes to IBM KLCI itself 30%. So again, KLCI futures influence more than IBM KLCI. Okay, so that is what we can say from this slide. Granger causality test. let me explain to you about, oh, I got 10 minutes left, 20 minutes left. So gradual causality test, actually we are trying to see the influence of KLCI futures, which KLCI historical return. So in here, legs 1, leg 2, 3, and 4, 5, it means that we are trying to see what will be the return today with KLCI yesterday, what will be the return of futures, KLCI futures today with 2 days ago for KLCI. Again, what will be the return for KLCI futures today with the 3 days ago of KLCI and so forth. So it seems that FKLI give early signal before NPM KLCI react. Again, it explains that futures prices don't just follow the market, they predicted it. So if FKLI move, KLCI will likely follow shortly after. Again, the 3 stars here, it shows the significance of the observation. In essence, we would say that we can treat FKLI as leading indicator, check its movement before placing trade in spot equities or any ETF that tied to KLCI. So let's just say you are trying to trade stocks, probably you don't need to see KLCI. Instead, you see KLCI futures. Okay, you see KLCI futures, where it goes. If it goes down, probably your stocks also will go down. Probably, not necessarily, probably. Right? Okay, how about the vector autoregression model? We are trying to model what will be the influence of historical return of KLCI and KLCI futures be given first leg, second leg, third leg, fourth leg, and fifth leg. Overall, we can say that FKI affects IBM KLCI more than the other way around. Spot equation in here shows that KLCI futures has strong repeated influence, meaning that futures prices help move the stock index. So other than that, FBM KLCI has little effect on FKLI, as the futures equation here on the third column shows fewer and weaker effect. So the index, if you are trying to trade KLCI futures, the index not really helping us much. Right. Okay. So in essence, first to watch FKLI before the market opens. If FKLI moves sharply, it always give us the indication how IBM KLCI stock will behave next. Number 2, right, strong trends, don't fight them. Sometimes, the strategy of hope not really useful when we try to apply it in the futures market. Number 3, always use confirmation to manage your volatility. Wait for the 2-3 candle. 2-3 candle means in the hourly chart, right? Okay, so I think we have the other. Right. So in order to confirm our sharing just now, so let's just us do the backtesting, intraday strategies backtesting. These are 5 common strategies. Day trading, scalping, mean reversion, swing trading, trend following. These are all very common. Day trading, we use MA 1 hour. Scalping, we use the RSI. Mean reversion, we use the Bollinger Band. Swing trading, we use the crossover between 5 hours versus 20 hours. Trend following, MACD. However, among all these 5, which one will actually give us, more chances to profit? Okay, the orange line here, really obvious. What will be the orange line? It's a swing trading. The so-so one, green and red. Green and red is a trend following and mean reversion. The one that we need to avoid is, what is this? Day trading and scalping, right? So overall, probably after COVID, I would say this is the COVID period, 2021 to 2022. Overall, after COVID, it's good to use swing trading, as in like MA's crossover to trade KLCI futures. Okay, so swing trading, in conclusion, swing trading works best FKLI respond well to short versus long average signal, making the strategy the most profitable. Yes, empirically, yes, I would say. Trend following is okay. Only if we can see there is a strong trend. If some of you really like to plot the lines, some of you really like to use indicators, oscillators. If there is trend, use your trend following. Day trading and scalping, you are doing charity to the brokers, I would say. Okay, you are doing charity to brokers, you're giving out the commission without profiting anything. So probably you can consider swing trading and trend following if you want to trade the LCI futures. Right. So this one is extra. I want to share tonight. Maximum drawdown by strategy and also the value at risk across the strategies. So we are looking for the least max drawdown, which is yes, swing trading only 14%. How about VAR? VAR value at risk, the mean reversion is the one giving us the least. Although swing trading is the best one that worked out in here just now, the VAR, which is the maximum you can lose in 1 hour, is still, I would say, considerably high, which is 2% for 1 hour losses. So these are the things that you need to watch out when you are trying to trade the LCI futures in hourly setting. All right, that will be all for LCI futures. Let us, I still have 15 minutes. FCPO, again, FCPO, I think this one, just for a glance, everyone knows contract size 25 metric ton, every 1 ringgit movement, 25 ringgit equals to 25 ringgit per tick, physically settled. So that's why you need to liquidate your position when your brokers ask you to do so. I would say a lot of situation of overloss due to reluctance or ignorance by the traders despite several warning. So probably you need to watch out. Okay, if you are trading a second month, particularly, be careful. This one is physically settled. If you want to go through, I have a lot of experience handling non-intentional physical delivery situation, but the one we will discussing in other occasion. Trading hours the same, 3 session. Leverage, we cannot trade physical CPO. Instead, we can just use CPO futures. Still, you can use your hedging, speculation, or arbitrage as what the exchange stipulated here. All right, let's go further. Your left-hand side, the mean, the median, the minimum, and the maximum of the price. On your right-hand side, the same, just keep the statistics that I show you for LCI futures. Let us go to the next slide. Okay, so how's the hourly FCPO in the past 4 years? No clear direction. Again, FCPO doesn't trend up or down consistently. It's always going up, going down, this, around that figure. That is something, how to say, if today it moves around 0.5%, there will be no chance tomorrow it will move 5%, from 0.5 to 5%. So basically, if today you can earn about 0.2%, tomorrow there's a high possibility for you to earn around 1.8 or 2.2 or 2.3, 0.23% for that particular day. So it won't be like any large movements of return. Big price swing. This one is the same like, sorry, the minimum is negative 0.635, the maximum is 6.5. It shows that if you trade hourly CPO or for long position, it will give you much or larger opportunity to earn rather than your short position as shown here. Prices can swing a lot in either direction. Yeah, it's quite a lot. 6% is quite a lot. I think it will, it will touch what do you call this condition for circuit breaker. Number 3, moderate volatility, 0.75 is not so much for us to think about. Most hourly moves are small but still tradable, suitable for scalping. But again, it's a futures market. Stay alert for sudden spike. Strong downside risk, skewness, negative 6.78. Big drops happen more often than big gains. So that's why in futures market, once you earn, you better get out from the market, because we don't know that our greed basically will lead us to stay longer, and so happen sudden drop or sudden spike will jeopardize your position. Lastly, extreme price jump, rare but powerful price shock are real. Protect capital with stop loss. Avoid overtrading breakout. Some of us really look for breakout. Very popular. Wait for breakout, wait for breakout, wait for breakout. The thing is, CPO futures really showing extreme price jump. So if let's just say you are losing and you are waiting for, let's just say there is a price breakout and only I will liquidate my position, it will not work out most of the time. Okay, it will not work out most of the time. So it's basically saying that if you are losing, it's better for you to get out as soon as possible, as early as possible. Or if let's just say the market remain calm, okay, let's just say the market remain calm, but you are still in the money, your position is in the money, keep it, get out from the market and keep it. What yours is yours. Okay, so I would say that is the safest way for you to trade CPO futures. All right, again, Hasbro information share out of these four: soybean oil, gold, crude oil, NYMEX WTI, and also soybean. I would say that for the short term, try to refer soybean more than soybean oil. Okay, because it contributes more to the price movement by soybean than the soybean oil. For long term, yes, we have to refer to seaboard bean oil. However, looking at the COVID-19, although gold futures and also the crude oil, these two commodities are very, very much a reference, a benchmark for the economy. It doesn't really work well for CPO futures, because CPO futures, they are really loyal to bean oil. You always see, if my bean oil goes down, I'll go down. If my bean oil goes up, I will go up. So if let's just say there is crisis, okay, there is crisis, because some of the scholars say every 7 to 8 years there will be crisis, or it's due to correction. But let's just say crisis. It's better for you to, if you're trading CPO futures, pay more attention to bean oil rather than these three. Why we are saying this, why we are determining this? Because it will save your effort, rather than you looking for this other, rather than you looking at these four, you just focus at one. Right. Next, so soybean oil is the strongest leader. It leads short-term and long-term price movement. Seaboard soy only reacts in the short term, and as we mentioned just now, gold and oil no longer strong indicators, although they are popular globally. It is barely a leader in CPO futures price discovery. All right, so again, we are using econometric model of threshold gauge to study the volatility in CPO price swings or return. Why? Because commodities like palm oil easily affected by fundamentals like weather, export bans, or changes in oil price. Probably we need to add one more, which is tax competition by Indonesia. I still remember last time when Jokowi playing around with the tax, it's really hurt us at best. So Jokowi is no longer around, okay? However, we still have to make sure what is the new president Prabowo is, having in his, in his shirt. So this event caused a big price jumps or drop. So threshold gauge helps us measure volatility more accurately, especially when prices fall hot, as it reacts stronger to bad news than good news. This one is very similar to FKLI futures just now. So again, we are looking at three. For now, it's three, or the gamma, the alpha, and also the beta, whereby the gamma tells us whether the price drop make volatility spike more than price rises. The alpha, how fast a short-term shocks affect volatility, and beta tells us if volatility tends to stay high or low for a long time. All right, quickly, Alpha, volatility reacts quickly to market news. Alpha 0.2895. I see a very good numbers here, whereby omega or alpha and beta are all showing, you know, a good validity in terms of statistical significance. Alpha, when new information comes in, like policy or weather, I think like something like this. If let's just say in the US at a plantation, at a soybean plantation, if let's just say there is something happen to bean oil due to the policy or the weather, CPO futures really efficient in reacting. So short-term trades can work well in this situation. Gamma, gamma not really significant. We still need to know, but then not to focus too much about it. Price drop seem to cause bigger panic than the price rise, but I see both. I see both. Last time I saw both of the sentiments, regardless of bullish and bearish, it will give almost the same magnitude with each other. Beta 0.4349, volatility doesn't stay. Volatility is there, but the thing is it won't stay there. It won't stay high for long. It will move. The market will move. The market will always move. So the thing is, okay, big move come down relatively fast. Of course, the shock comes in, people in fear. However, it really stayed that long. So you don't need to fear prolonged chaos, just watch for the spike and act quickly. At this juncture, your stop loss matter. All right, in essence, always set stop loss. Again, bad news, it's harder. Although we have not really significant coefficients of number just now. Quick move, quick fades. So these are all three that you need to take note for your hourly trading, intraday trading. Again, we are doing backtesting. We are using the same parameters or same strategy we use in KLCI futures. Again, the scalping and day trading, also the red one, the mean reversion will not give us any beneficial earnings. Instead, we should probably focus more to use swing trading and trend following. Okay, swing trading, as in like using the MA5 versus MA20 is the most profitable strategy. It gives you up to 200%. I think there is a record. Making it the best choice for CPO. It works by catching medium trends without reacting to every small price move. We call it as a noise. So noise really gives you false signal. So probably swing trading, set right? When you set your hourly chart, okay, when you set your hourly chart, probably set as well your MA5 and also MA20. It's not MA5 days, MA20 days, but then MA5 hours and MA20 hours. Number two, trend following, which usually people will use MECD, give us a decent result, produce about 50% gain, okay, whereby you can earn 50% out of the trade. This strategy works well when strong price trend exists. This one, I would say we need to find out and determine if there is a strong price trend. Yes, we can use. If not, I would say better to watch out or focus to use swing trading and avoid day trading and scalping. So I like to give more convincing points about the backtesting from the angle of maximum drawdown and also value at risk. So maximum drawdown for the largest one is day trading and scalping. Yes, we potentially lose about 87% or 79% if you use these two in one single hour. So avoid this. Probably we can use a mean reversion. However, mean reversion will give us, say the swing trading method just now. Give us the VAR of about, this is quite small for us to put a value on it, probably less than 5%. Okay. So other than that, not so much significant or noticeable metrics. All right, let's move on. Okay, I think we finish up on the KLCI futures and CPO futures. Now, at a short glance, I would like to share one thing or two about single stock futures. So as we know, single stock futures is basically they consist of FBM KSI components that are being allowed to be short sell. So we have from financial services to energy. However, the most that positively correlated with FBM KCI is financial services. So the least one is the energy, which is a Petronas chemical. All right, so how are you going to trade based on this information? First, try to consider index tracking strategy. You can trade SSF. SSF, it reminds me of a shop, SSF shop, a furniture shop, but that's not that. This is a single stock futures. Trade single stock futures that closely follow MKLCI, probably Maybank or Press Metal, for directional exposure or hedging. Strategy: if IBM KLCI shows bullish signal, you can go long on the SSF. If bearish, go short to track the index drop. For example, if the index go up, you can long SSF because it will move in tandem. The Maybank SSF will go up in tandem with the index. Next, you can consider diversification and hedging strategy for the one that's having low correlation with the index, such as healthcare and energy component. How to do it? Use low correlation SSF and hedging tool during market uncertainty. This one is you want to do diversification and hedging strategy. Next, relative strength or sector rotation. During bullish, you can prioritize financial, industrial, utilities because they have a high beta. Okay, they have a high beta to FMKLCI. However, during uncertain, you don't know where the market is going. Try to switch to consumer, healthcare, or energy due to lower correlation and volatility. So, for example, here during a market uptrend, you can long Maybank or Press Metal. During correction or reversal, you can change to Nestle or IH. So that is a relative strength. Sector best. To exploit relative outperformance, sometimes the stocks tend to be outperformed. So what we can do, only pick one high correlation such as Maybank and one low correlation such as IH. So if FBM is trending, you can long the high correlation and short the low correlation. So theoretically, it will give you some safe position if you combine those two. Next is event driving. Focus on stock with low correlation, which react more to idiosyncratic events. And you can also use SSF to leverage exposure if you have, very, very low tolerance about stop losses. For example, trade Petronas chemical, SSF before, or if you're foreseeing any crude oil news going to come up tomorrow night, tonight, whatsoever. So that is event driven. Next is defensive. Defensive, we try to do rotation between cyclical and defensive, whereby cyclical is high correlation. Defensive is low correlation success depending on macroeconomic signals. How to do it? Probably we can bullish, during bullish, we can long Maybank or Gamuda. During bearish, we can change to defensive, as defensive counter, as in like Nestle or IHH. So that is defensive. For short-term hedging during macroeconomic shocks, what we are trying to do is to hedge exposure to sudden macroeconomic shocks. How are we going to use it? We can use high correlation SSF to quickly hedge beta exposure to FBM KLCI. And it's also very effective for to cover yourself during overnight gaps. For example, you can short Maybank to hedge FBM KLCI related downside risk during Fed rate decision. It's just last month. All right, last slide. If let's just say you have a big capital, you can try to combine FKLI and FCPO. However, The recommended position will be one contract CPO with 5 KLCI futures. So that is the best recommendation. I will say this recommendation will give you quite low risk and high probability of earning. So based on the data that we have during the computation of the strategy, the Sharpe ratio probably can give you up to 20. Okay. The value added rate is 1.3. The maximum drawdown is something that will not favor. Okay. However, we need to bear because we are trading derivative, high risk, high return, 47%. Okay. All right. I think that will be all. I pass the floor to Mr. CY.
All right, thank you very much, Dr. Daniel, for your informative sharing. I'm sure our audience has gained lots of valuable knowledge and insights about the advanced strategies that works for FKLI and FCPO day trading. And before we enter into our Q&A section, if you have any questions related to Dr. Daniel's presentation, please type your questions in Slido so that I can easily capture and address them. While waiting for questions to come in, I would like to ask a small favor from all of you. Please take a small minute to fill out this feedback form, since we have provided an informative session today and it will only take you less than a minute to complete. You can find the feedback form link in the chat box, or you can scan this QR code with your smartphone. So your feedback is incredibly important to us, as it helps us improve our future sessions and ensures we continue to deliver high quality content to tailor your learning needs. So please take a quick minute to complete the form and we will begin with the Q&A session shortly. Another 20 seconds to go. All right, a minute has passed. If you have already submitted your feedback, thank you very much. And if you're still completing it, feel free to continue. Now let's move on to the Q&A session. Now, to ensure we cover as much question as possible, I will select the most relevant questions from Slido and rephrase them for clarity. And please understand that due to time constraints, we may not be able to address all questions. So, Dr. Daniel, are you ready for Q&A?
Carry on.
All right, the first question. Now, for swing trading, the FKLI, is there any specific time frame, and what would be the holding period that would be beneficial?
All right. Swing trading, basically, even if we're talking about day trading or hourly trading, preferably for you to keep your position during the session. Let's just say you start your trading during the morning opening. If let's just say you are earning, preferably for you to close out your position before the market close for the morning session. And let's just say you start your trading in the afternoon session, you can start over. I would say that if I were if I were the trader, I won't be keeping my hourly position if I intend to do it for the hourly trading. I won't be keeping it from morning session to afternoon session due to the different nature of volatility for morning and afternoon session.
Okay, so it seems like the day trading that you are, I mean, the swing trading that you are referring to is actually doing swing trading within the day. Am I correct?
Yeah, correct.
Okay. Now the next question, for FKLI, just now earlier, I think you got mentioned that regardless of whether it is high volatility or low volatility, we should not be adding contract in our trading. So, is there any reason behind this?
Okay, volatility is always defined as risk. So the more you add your contract, we can equally define it as the more you add your risk. So this one is actually conditional. Let's just say you have a bigger, bigger trading account balance. Probably you are comfortable to add more and you can embrace more risk. I would say that you can go ahead. The thing is, it's not advisable due to, as we can see just now, FKLI actually already shown us there is a sudden spike and sudden drop. So although you are, adding more contracts or adding more position, if it goes your way, means that you can have a good night's sleep. If it doesn't go your way, you will have a nightmare. So to be able to sleep well at night, just keep it low, okay, for a while. Then only the if there is if there is a good time for you to liquidate, just close off everything. Then what you say, liquidate your positions. I would say that if I am the trader.
Okay, while we are still on the same question, how about for FCPO? Whether whether is it suggestible for us to add contract or do not add contract, regardless of the market volatility?
Okay, regarding the aiding the contracts, right? It reminds me of something that I read from empirical papers. It sounds something like this. The first time when you enter the market, let's just say three contracts of CPO or KLCI futures, the first time you enter the position, probably with the three contracts, that will be the most calculated decision, the most thoughtful and the most careful decision. After that, let's just say the market goes your way, and of course the greed, the greed will influence you to add more, and add more. However, I would say that by the time you add more contracts or more position, that decision is no longer based on careful or thoughtful or calculated decision. So it's very, very dangerous. It's just based on grit and grit and grit. That's it.
Okay, so does that mean that if we want to trade more, we should actually focus on our first trade?
Yes, I would say like that because let's just say you are having three contracts and after that you are earning, it is best for you to just sell it off or liquidate it or take home your earnings and after that rest for a while. Or let's just say during in the morning session you earn some, okay? It's better for you to close off all your positions and after that start over again in the afternoon session. So that will give you good rest, okay, although it's just a 2 to 3 hours rest and give you time to analyze whether should you really go again or should you really stop for the day. So I would say that in that sense, higher risk instruments like CPO and LCI futures, this is actually based on your psychological factor. If you're not really certain about your move, it's better for you to back off for a while and rethink again.
Okay. Now, earlier you shared about swing trading strategies. Can you share about what are the conditions for entry and exit for the swing trading strategies that you mentioned earlier?
Can you specifically mention about the condition? Which condition do you mean?
I think the answer question is probably it's what would be the swing trading strategy that you are referring to. For example, what parameters that you are, what indicators or parameters that you are looking at.
All right. Okay. Let's just go back to the slides. All right. Swing trading, I would say that moving average is basically will give you much powerful plots than using the other indicators because it will give you a crossover plots between the MA 5 hours and also MA 20 hours. That's a very basic and common rule. If let's just say the 5 hours doing an upward crossover over 20, so it's a signal for you to buy. It sounds very simple and straightforward. It's not as complex, it's not as flashy as other indicators. But then for me, whatever, as long as it works well, okay, it means that it works well. So the other way around, if let's just say the 5 hours actually doing the downward crossover of 20 hours is a signal for you to sell. So other than that, it's not really convincing for me for now, based on what I have, in my slides. Yeah, it's just that why I chose 20 hours is basically it reflects 3 days. 5 hours, it reflects one, one trading session. So if let's just say one trading session actually moves better or give you convincing signal than 4 or 5 days of trading session, it means that there is a clear signal for you to either short or long.
Right. Because of time constraint, we are going to take another two more questions. So there's one question about the time frame for intraday trading. Are there any suitable time frame for doing intraday trading, whether is it for FCPO or FKLI?
All right. For KLCF features, there is not really specific time frame, but for CPO, you will see a lot of volume during 4 o'clock to 6 p.m. So the last 2 hours of the afternoon session. So probably that will give you more opportunity to, to execute your swing trading or to execute your, what was just now the trend following strategy. So bear in mind to be careful. In between 4 p.m. to 6 p.m. I think that's about it.
All right, we are going to take one more last question. Early on, you shared some statistics, right? So based on the statistics, whether we can use Dow or HSI as the leading indicator to gauge our Malaysia market.
Although if let's just say we are looking at a long term, I'm not really advising for us to, referring to mini Dow. However, if let's just say we're in the midst of crisis, still it depends on which crisis that is this global, is this regional? Because COVID-19 basically give us some signal that anything global, it will affect LCI futures significantly. So for short term, no. For long term, probably yes, but not every time. So that is mini Dow. Instead of mini Dow, probably we can pay more attention to Nikkei or let's just say Hang Seng.
All right. And any specific reason that we can pay attention to Nikkei or Hang Seng?
Okay. I would say that Nikkei and Hang Seng, they are regionally developed markets in Asia. So there is no other market so far, I would say, at my best knowledge, can be, the best predictor or the best indicative for the future movement of the KLCI futures. So based on Nikkei 225 futures and so Hang Seng Index futures, I would say that these two can give us good and clear where the KLCI futures would go next. Particularly Nikkei, I would say that out of out of 5 periods of observation, okay, short term, long term, during COVID, a global financial crisis in Eurodebt, 4 of them shows that Nikkei will give us a good, good early indication and good signals. About HSI, it still works well, works better than looking or referring to European stock index features such as FTSE 100. So that's the reason why.
All right. Thank you very much, Dr. Daniel, for answering our participants' question. Now it's time for me to conclude today's webinar session. Now, once again, I would like to take a moment to remind you about our upcoming webinars, especially for those who may have missed the earlier announcement. Now, the LLF Let's Learn Futures webinar series features a variety of topics scheduled every Tuesday evening from 8:30 p.m. to 10 p.m. We cover a wide range of content-packed and informative topics where you can gain practical knowledge about futures trading from our experienced speakers. So if you're interested in joining any of these sessions, simply scan the QR code to register for the topics that you would like to attend. Once you scan the QR code, you will be directed to a page where you can access to our event calendar. And to join our upcoming sessions, simply navigate to the Tuesday column on the LLF webinar topics session. Click on the session you're interested in and proceed with your registration accordingly. Now, besides our webinar, we also offer the LLF online workshop. And this workshop is specifically tailored for those who are new to the futures market. And if you are interested in learning about futures trading in details, then this online workshop is ideal for you. So you can take a picture or screenshot this page and register yourself right after this webinar ends. And feel free to share this event with your friends and family who are also interested in futures trading. We will guide you step by step on how to start trading your first futures contract. And please note that each session is limited to the first 50 online attendees. So be sure to register yourself quickly to secure your seats in both workshops. Again, once you scan the QR code, you will be directed to a page where you can access our event calendar. And to find the LF online workshop session, simply look for them in the Saturday column. Click on the workshop session that you are interested in and proceed with your registration from there. Now, for those of you who may have not already know, you can explore the Derivative Trading Simulator, DTS, in Bursa Marketplace. This simulator allows you to engage in paper trading, helping you to familiarize yourself with using a futures trading platform. You can register for a risk-free trading experience and give it a try to start developing your interest in futures trading. It's a great way to learn and gain hands-on experience through this trading simulator. And finally, before we conclude this webinar session, allow me to introduce you to Bursa Academy. Now, Bursa Academy is a comprehensive one-stop e-learning platform where you can access all the information and knowledge about stocks, futures, and other products traded on Bursa Malaysia. You can access this by scanning the QR code on your right or by searching for Bursa Academy on Google to find the link. You can visit this site for more detailed information and resources. It's a valuable resource to enhance your understanding of trading in Bursa Malaysia. All right, we have come to the end of our webinar session today. Thank you, Dr. Daniel, for sharing such an informative topics with us. And to all of you who joined us, thank you for your participation. We hope you found this webinar both informative and valuable. And I believe you have gained new knowledge in how to trade the derivatives market better, as shown by the studies that Dr. Daniel has shared with us today. So with that, I'm CY signing off for now. Enjoy the rest of your day and have a great evening. Until next time, bye bye.